Hi and welcome to another video about insurance. This time I'm going to be telling you the difference between indemnity and agreed value income protection. A lot of people don't realize it, but there are two distinct different products when it comes to income protection, and they are very different. Um, Probably the best way to explain the difference is that to get agreed value is slightly more complex than getting indemnity. Now, indemnity is very popular with online websites, such as the ones that you can find online, but they all sell a product called indemnity. Now, the best way to describe what indemnity is to use the similarity between insurance that you're familiar with. So let's look at car insurance, for example. Now, let's just say someone's bought a car and they've paid $100,000 and say borrowed 80,000, which seems a lot of money, but it's only an example. Now let's just say 3 years on, they still owe $70,000, but the car's gone down, so the value of the car has changed. And this is where you hear a lot of people saying, oh, damn insurance company, they never paid out the money of what the car was worth, because the value of it is based on the indemnity value at the time of claim. So the car's gone down in value. So the position is here. You've got someone here that's got a car that's worth less. They're probably paying out insurance based on the car when they bought it, but the net position now is negative 20,000. So they're actually worse off in this situation. So this is kind of the difference between indemnity and agreed, because agreed value, when you take out agreed value policies on a car, you'd probably at the minimum amount take it out at $80,000. So if anything happens, you've covered the amount that you've borrowed. Now the same applies, or the same type of principle applies when you look at income protection on people, not cars. So let's take a look at good old Tom. So let's just say Tom earns 100,000. Now I know you all don't earn 100,000, but it's just an easy number to work with. That's why I've picked it. Now an indemnity policy would cover you up to $75,000, and that's 75% of anyone's income. Now what's important here is to get this cover here, all Tom needs to do is to say that he earns 100,000 and does not need to provide proof of income. This is really important. There's no need for Tom to provide proof of income when he takes out that policy. Now let's just say Tom's income goes down to 80,000. Very similar to the car. Now not a lot of people that are employed, their incomes go down, but this is very applicable to people that are self-employed because their incomes fluctuate. So if he goes on claim, he's only going to get paid 75% of this value, not this one, even though he's paying his premiums based on 75,000. So in this case, Tom would receive $60,000 gross. So as you can see, it doesn't really fit the bill for someone that's self-employed, particularly for self-employed. So you really need to watch this one. Now let's look at an agreed value position. So if Tom earned $100,000, he would need to provide proof of income at application time. So it's just another process that you'd have to go through, and that's why most of the online insurance providers don't provide agreed value, because they've got to do some extra work. But it's in your interest to get agreed value because it's absolute provides certainty. Now Tom can get covered up to 60%, and some companies will go up a little bit higher, and it's all based on the amount of income. Obviously they have tiered structures, but generally speaking, they'll cover up to 60%, not 75%. The reason being is because this is deemed to be a net position, so it's net of tax, whereas the other one, the indemnity, there's tax payable on it, on the claim. So if Tom goes on claim, he'd be paid $60,000, and this is the amount that was agreed at application time because it was underwritten. So it just gives that feeling of certainty. You might have heard of a lot of people, especially with ACC claims, they took ages to pay out. Well, it's not their problem, it's not their fault. It's just that they need to prove to their internal processes that you actually do earn that money. So there is always a hold up. So this is why the agreed value position is just so much better for an individual rather than having to delay the hassles at claim time. I hope you found that video of some help to you, and if you need any more help or have any other questions, feel free to call the number on the screen.